So, you did everything right. I mean, you saved diligently your whole career, you maxed out that 401k, and now you're sitting on a beautiful $1 million nest egg. First off, congratulations. But what if I told you that very success, that discipline, could actually trigger a massive hidden tax bill in retirement? Let's unpack how on earth that's possible and, more importantly, what you can do about it.
And look, this isn't some scare tactic. This is a real and frankly shocking outcome that financial researchers have identified. It affects a very specific group of retirees. The twist, as they say, is that the very people who were the most responsible savers could end up with the biggest tax burdens of their entire lives, long after they've stopped earning a paycheck. It's wild.
So who are we talking about here? This isn't a problem for the mega wealthy, not really. This tax trap is perfectly set for savers who build up between $1 and $3 million in their traditional tax-deferred accounts, your 401ks and your IRAs. And that's a number that millions of disciplined Americans are on track to hit.
I know what you're thinking. It seems completely backward, right? You delay paying taxes your whole life so you can save more, only to get slammed with a huge bill for it at the finish line. So how does this actually happen? Well, it's not because you did anything wrong, it's because of a little-known chain reaction that's built right into our tax code.
This chain reaction has a nickname, and it's pretty fitting. They call it the tax torpedo. It's this hidden threat that just comes out of nowhere and strikes right when you're supposed to be relaxing and enjoying your golden years. And it all begins when the IRS essentially takes the steering wheel away from you and takes control of your withdrawal strategy. The weapon they use for this is something called Required Minimum Distributions, or RMDs for short. Basically, once you hit your early 70s, the government comes knocking and says, hey, you've deferred taxes long enough. Time to pay up. You must start taking money out of that account whether you need it or not. And here's the kicker. Every single dollar of that forced withdrawal is taxable income. All of a sudden, your control over your own money. It's gone.
Okay, so here's how that torpedo actually hits. It's a three-step process. First, that RMD forces you to take out taxable income. Simple enough. But the real damage, the sneaky part, is step two. That new income can cause a much larger portion of your Social Security benefits to also become taxable. You're essentially getting hit twice on the same money, which creates this phantom tax rate that's way higher than anything you'd see on a tax chart.
So let's look at this first danger zone. If you think you're in the 12% tax bracket, the reality can feel completely different. In this zone, for every extra dollar you're forced to pull from your IRA, it can drag 50 cents of your Social Security benefits right along with it into the taxable column. So you're effectively being taxed on $1.50 for every dollar you take out. Your real tax rate, what it feels like, is suddenly closer to 28%. And if you thought that was bad, it gets so much worse if you're in the 22% bracket. In this zone, each dollar from your IRA makes 85 cents of your Social Security taxable. Now you're being taxed on what feels like $1.85 for every single dollar you withdraw. Your true marginal tax rate, the tax on your very next dollar, spikes to over 46%. This is the math. This is the smoking gun that explains how so many people are shocked to find they're paying more in taxes than when they had a full-time job.
So who exactly is sailing into these dangerous waters? Most people assume it's a problem just for the ultra-rich, but the research shows the exact opposite is true. The wealthiest retirees often have strategies to sail right past this torpedo.
The real target is a group that some researchers have started calling the middle affluent. And these aren't high-flying executives or big-shot entrepreneurs. No, these are the people who consistently saved in their company 401k for 30 or 40 years, building their wealth bit by bit through sheer discipline, not some blottery windfall.
Let's make this really personal. The people who get hit the hardest are teachers, nurses, engineers, IT managers, federal employees, military personnel, and mid-level managers. These are the everyday heroes, the backbone of our economy, who followed all the rules, built a 7-figure nest egg, and now are unknowingly heading straight for this tax torpedo.
Okay, so that's the trap. It's pretty scary stuff. But here's the good news. Because this tax bomb is so predictable, it is also preventable. There is a way to regain control to defuse this threat, and it all centers around one incredibly powerful financial tool, the Roth account.
I mean, just look at this comparison. It's truly night and day. With a traditional IRA, the IRS dictates your withdrawals through RMDs. With a Roth, nope, no RMDs for the original owner. You are in complete control. Withdrawals from a traditional account are taxable, and they're what triggers that tax on your Social Security. But Roth withdrawals, they are 100% tax-free and completely invisible to that Social Security tax calculation.
So when you put it all together, using Roth accounts strategically can slash your lifetime tax bill, completely eliminate those forced RMDs, and it can even keep your future Medicare premiums lower, since those are also based on your income. The bottom line here is you gain total control and you end up with more spendable after-tax wealth.
All right, so how do you get more money into a Roth, especially if you've been saving in a traditional 401k for decades? Well, it turns out there's a critical window of opportunity, a sort of golden age for retirement tax planning that most people just completely miss.
The key strategy here is something called a Roth conversion. All this is you intentionally move money from your pre-tax traditional IRA into an after-tax Roth IRA. Now, you do have to pay income tax on the amount you convert, but here's the genius of it. You do it when your income, and therefore your tax bracket, is at its absolute lowest point.
And here is that golden window. For most people, the years between when you retire and when your RMDs start are the lowest income years of your entire adult life. Think about it. Your paycheck is gone, but the RMDs and maybe even Social Security haven't kicked in yet. This is the prime time, the sweet spot, to make those Roth conversions at a much, much lower tax rate.
Let's just compare the two paths for that same $1.5 million saver. On path 1, the no-action path, their IRA just keeps growing, their RMDs balloon to over $80,000 a year, and that tax torpedo hits them hard. But with strategic Roth conversions, they actually shrink their future IRA balance. Their RMDs could get cut in half, keeping them safely out of the torpedo's path and leaving them with lower taxes and, most importantly, total control.
You know, this all leads to a huge shift in thinking. The goal of retirement planning isn't just to save some big number. It's about saving that wealth in the right types of accounts, some taxable, some tax-deferred, and some tax-free, so that your future self has choices, flexibility, and above all else, control.
So it really all comes down to this one simple question. You spent a lifetime working hard, saving diligently, and building your wealth. After all that effort, are you going to let the IRS dictate your retirement income, or are you going to take control of your own tax destiny?